Welcome back to the deep dive. We have a stack of research on the desk today that hits incredibly close to home, literally.
Hmm.
We're looking at what is probably the single biggest stress test for the modern family. You know, we talk about the sandwich generation all the time,
We do.
but I think the reality is so much harder than that buzzword. You're in the middle, trying to raise your kids, maybe save for college, and at the same time, your parents are getting older.
Yeah.
And that question of where will they live is moving from a vague future worry to a 3 a.m. panic attack.
It is a pressure cooker.
Hmm.
And the heat is coming from all sides. You have rising healthcare costs, people living significantly longer, and a housing market that is, frankly, hostile to anyone on a fixed income.
Right.
So when you try to solve this with real estate, the math just breaks down almost immediately.
That's the perfect starting point for today. Because traditionally, the banking system has this very binary view of the world.
Yeah, black and white.
If I want to buy a house for my mom because she can't live alone anymore, the bank doesn't see dutiful son. They look at me and say, great, you're buying an investment property.
Exactly.
And suddenly I'm getting hit with higher interest rates and down payment requirements that look like a ransom demand.
Which is why the documents we're looking at today are so fascinating.
Ugh.
We're digging into a specific set of 2026 guidelines analyzed by Genesis Mortgage out of Florida.
Okay.
And they're highlighting something called the Family Opportunity Mortgage.
Yeah.
Now, I want to be really clear right off the bat. This is not a marketing name. It's not some niche product from one bank.
It's not a pop-up ad.
No, this is a fundamental guideline tucked away deep inside the Fannie Mae handbook.
So just to be clear for everyone listening, this isn't a product I buy off the shelf. It's a rule I can leverage.
Precisely. It's
Right.
a provision, specifically sections B2101 and B2301 for the note takers out there, that completely changes how a lender defines occupancy.
And occupancy is everything in the mortgage world.
It's the whole ballgame. It dictates your rate, your down payment, pretty much your approval odds.
Let's dig into that idea of occupancy. Because usually it seems pretty clear-cut. Either I sleep there or I don't.
Right.
If I sleep there, I get the primary residence perks. If I don't, I pay the premium. So how does this guideline blur that line?
Well, you have to look at it from the bank's perspective, which is all about risk.
Okay.
Typically, they believe that if the economy tanks and you lose your job, you're going to pay for the roof over your own head first. You'll fight to keep your home.
But that rental property across town.
You'll walk away from that. That's why investment loans are so expensive.
Yeah.
But the Family Opportunity Mortgage, it flips this logic.
Mm-hmm.
It allows a borrower, let's say you, to buy a home for an elderly parent or a disabled adult child.
Mm-hmm.
And even though you, the borrower, will never spend a single night there, the bank agrees to treat it as your primary residence for the sake of the loan terms.
That is a massive distinction. So I stay in my house, my mom moves into the new condo, but on paper, the bank treats that condo as if I'm the one living in it.
That is the mechanism. It creates a loophole of sorts, though, the banks would call it a guideline,
Yeah.
where the family connection acts as a proxy for occupancy.
They're betting I won't let my mom get foreclosed on.
They're betting that your emotional attachment is just as strong as if you live there yourself.
I want to pause on the financial impacts of that because I think it's easy to glaze over terms and conditions. When we say the terms are better, are we talking about saving $50 a month? Or is this a deal breaker difference?
Oh, it is often the difference between the deal happening or not happening at all. Let's look at the data Genesis Mortgage provided. First up, interest rates.
Okay.
If you categorize a purchase as an investment property, lenders typically tack on a risk adjustment. You're looking at a rate that's 0.5% to a full 1% higher than standard.
Which, on a $300,000 or $400,000 asset, that compounds into a mountain of interest over 30 years.
A literal mountain. But the bigger barrier, the one that stops most families cold, is the down payment.
Right.
If you walk into a bank today to buy an investment property, they're going to ask for 15%, 20%, maybe even 25% down.
So on a $400,000 home, that's $100,000,
$100,000 in cash just to get the keys.
which most people in that sandwich generation definitely do not have sitting around. I mean, they're paying for daycare, student loans, their own mortgages. $100,000 is a fortune.
It's prohibitive. But because the Family Opportunity Guideline classifies this as a primary residence, you unlock standard conventional loan down payments.
Which means?
You can get in for as little as 5% down. And this is a key detail from our source material. If you combine this with a Home Ready program, that can drop to just 3%.
Wait, explain the Home Ready connection. What's that?
It's not automatic, but it's complementary. Home Ready is a program for borrowers who might not have a high income but have good credit. If you fit that box and you stack it with this guideline.
You could get in with 3% down.
Exactly. So we went from needing $100,000 in cash to maybe needing $12,000.
Yeah.
That completely changes the accessibility.
It changes the entire conversation. It goes from we can't afford this to maybe we can do this next month.
Genesis Mortgage ran the math on a $300,000 loan to prove this out. Between the lower interest rate, say 6.5% instead of 7.5%, and lower mortgage insurance costs, you're saving about $200 a month.
Okay, $200 a month is good.
But over the 30-year term, that's roughly $70,000 in savings.
Wow.
That's $70,000 that can go to caregivers or prescriptions or groceries rather than just vanishing into interest payments.
It feels like the system is finally acknowledging that this isn't a business deal. I'm not trying to flip a house for profit. I'm trying to house my family. But playing devil's advocate here, banks are not charities. There must be strict guardrails.
Yeah.
I assume I can't just use this to buy a vacation home for my cousin in Florida.
No, absolutely not. And this is where we have to be very careful because if you get this wrong, you could be committing mortgage fraud. This is not a loophole for casual real estate investing. The guidelines are very specific about the who. There are really only two scenarios that fly.
All right, walk us through scenario A.
Scenario A is the elderly parent. So, the guidelines define this as parents or parents-in-law.
And it's not just about age.
Not just age. Crucially, they must be unable to work or have insufficient income to qualify for a mortgage on their own.
Unable to qualify seems a little subjective, though. What if my mom has a great retirement account but no monthly job?
The lender's going to scrutinize that heavily. If your parent has the financial muscle to buy the home independently, you usually can't use this program.
So there has to be a need.
A financial necessity. You often have to submit their tax returns, their proof of income to show, look, they live on Social Security, they can't afford this. The program is designed for support, not convenience.
Got it. That makes sense. It prevents people from gaming the system. What's scenario B?
Scenario B is for a disabled adult child. The child has to be 18 or older. And similarly, the burden of proof is on you to document the disability and their inability to qualify on their own.
So medical records, things like that.
Medical records, maybe affidavits to the underwriter, yes.
You mentioned parents-in-law. Does it go any wider? What about siblings? I know so many people who are caregivers for a disabled brother or sister.
And that is the most common heartbreak with this guideline.
Yeah.
It strictly excludes siblings.
Really?
No brothers, sisters, aunts, uncles, cousins. If you want to buy a home for your disabled brother, you're back to the investment property rules. It's strictly vertical parents and children.
That seems like a massive gap in the policy, honestly. But okay, so we have the who. What about the how? If I'm the listener and I'm the one taking on this debt, what does the bank need to see from me?
This is where the rubber meets the road. This is where a lot of people get disqualified. You are the financial backbone. The bank isn't looking at your parents' credit, they're looking at yours. So standard credit score minimums, 620, but higher is always better.
Of course.
But the metric that kills most of these deals is the debt-to-income ratio, DTI.
Right, because I'm not just paying my mortgage anymore. I'm legally responsible for this new one, too.
Correct. And the bank adds your current housing expense to this new proposed payment, plus your car loans, credit cards, everything. And that total number usually cannot exceed 45% of your gross monthly income.
Maybe 50% if you have a lot of cash saved up.
Maybe. If you have strong compensating factors like reserves, yeah.
Is there any relief on that? Like if my dad moves in and he chips in $1,000 a month from his pension, can I count that to help the numbers work?
That is the biggest trap. And the answer is a hard no.
Really?
You cannot use projected rental income from the family member to help you qualify. The bank views that as border income, and they won't count it for this type of loan.
Wow. So even if the plan is for dad to pay the mortgage, I have to prove I can pay it 100% on my own.
That is the reality. In the eyes of the underwriter, if your dad stops paying, you're on the hook. So you have to qualify solo. It's a high bar.
It's a tough constraint. Now, our source material emphasized that we're looking at this through the lens of 2026 guidelines. Why does the year matter so much?
Well, the context shifts because of inflation and loan limits. The Federal Housing Finance Agency, the FHFA, has raised the conforming loan limit pretty significantly.
That's the limit for these kinds of standard loans, right?
Exactly. For 2026, in most areas, that limit is up to $833,000.
That's a big jump from a few years ago.
It is. And why that matters is it gives you runway. A few years ago, buying a second condo might have pushed you into jumbo loan territory, which is even stricter.
Right, higher down payments, better credit needed.
With an $833,000 limit, even in high-cost markets like the ones Genesis mentions in Florida, Winter Park, parts of Tampa, you can buy a very respectable property and stay within these favorable guidelines.
Let's make this tangible. The abstract rules are great, but I want to see how this plays out. The report included some case studies that I thought were really powerful. Let's start with Maria.
Maria is the classic sandwich generation prototype. She's 45, professional, doing well. Her mom is 78, living on a fixed Social Security income of about $1,800 a month.
And in 2026, trying to find a safe apartment for $1,800 a month is
Almost impossible,
yeah,
especially when you factor in utilities and food. She'd be living paycheck to paycheck.
if that.
Exactly.
Yeah.
So Maria finds a condo for $350,000 near her own home. Under the Family Opportunity Mortgage, Maria puts 5% down. That's $17,500.
Okay.
Her total monthly payment, including taxes and insurance, comes out to roughly $1,900.
Which is high, but Maria can cover that little gap between her mom's income and the mortgage.
She can, but compare that to the alternative. If she had to use an investment loan, she would have needed $70,000 down 20%.
Wow.
And her payment would have been closer to $2,200 a month because of the higher rate.
So this program saved her over $50,000 in upfront cash. That's an emergency fund. That's potential in-home care money down the road.
It completely changes the safety net. Instead of locking that cash into the equity of the house where she can't touch it, she keeps it liquid for her mother's care.
There was another example that hit the other side of this, the disabled adult child, the case of John and Lisa in Orlando.
This one really shows the flexibility. They have a 28-year-old son with cerebral palsy. He gets disability, but again, zero chance of qualifying for a loan on his own.
And they wanted him to have some independence.
Right, not live in their back room forever. They found an accessible home for $250,000.
And this is where they layered in that Home Ready program you mentioned earlier.
Correct. Because the son's income was so low, the household qualified for Home Ready terms. Combining that with the Family Opportunity Guideline meant they only had to put 3% down.
Which is a tiny barrier to entry.
It's nothing compared to the 20% they would needed for a second home. The source notes they used the capital they saved on the down payment to immediately install wheelchair ramps and modify the bathroom.
That's a great point. It's not just financial engineering, it's resource allocation. Instead of giving that money to the bank, they put it into the home to make it livable. There was one more scenario that I honestly hadn't thought of, the refinance. This feels like a hidden gem.
It really is, especially for people who maybe bought a place years ago and just set it up wrong. This is the story of Sarah in Tampa. Years ago, she bought a small home for her father, but she didn't know about these rules. She just bought it as an investment property.
So she's been paying a higher rate this whole time.
For years. Her father's now 82, still living there. She worked with a knowledgeable lender who flagged this. They refinanced the home using the Family Opportunity Guidelines.
And even with rates being higher now?
Because she moved from an investment tier to an owner-occupied tier, she improved her terms significantly.
And the source mentioned a cash-out component.
Yes. She was able to pull $20,000 of equity out of the house to pay for her dad's medical bills, and her monthly payment barely budged because the rate got so much better.
She essentially retroactively fixed a bad financial setup. That's a powerful tool.
It is. And, we've crunched a lot of numbers here, percentages and basis points. But I want to pivot to the why. Because when you read the testimonials in the Genesis material, nobody is writing thank you notes saying, I saved 12 basis points on my APR. They're talking about something else.
They're talking about dignity. They're talking about fear.
It's safety. There was the story of Elena. Her mom had early onset dementia.
Yeah.
And the choice Elena faced wasn't buy a house or don't. It was buy a house nearby or put mom in a facility.
And we have to talk about the cost of facilities. The source material mentions assisted living in Florida averages $4,500 a month.
Right. And that's for basic care. Memory care can be double that.
So when we look at Maria's $1,900 mortgage, financially, it's half the cost.
But emotionally, Elena talks about the peace of mind of having her mom in a bungalow down the street. She can visit every day.
Yeah.
Her mom has her own garden. She's not in an institution. You can't put a price on that.
And there was the Roberts family with their autistic son. They talked about the rental trap.
That is a huge fear for parents of disabled adults. The question of what happens when I'm gone.
Yeah.
If the son is renting, he's at the mercy of landlords. Rents go up, buildings get sold. For someone with autism who relies on routine, being forced to move can be traumatic.
Buying the home locks in that stability, it creates a permanent sanctuary that belongs to him.
It reframes the mortgage, it
Mm.
stops being a debt instrument, and it starts being a tool for family preservation. It allows for aging in place, which everyone says they want, but few people actually plan for financially.
It brings us back to that demographic tidal wave. We're seeing multi-generational households rise. I think the number is 15% of U.S. households now.
Yes, and climbing fast. The old model, the nuclear family, where everyone moves out at 18 and never looks back, that math is breaking down. Housing costs are too high, care costs are too high.
Yay.
Families are realizing they have to pool resources. And this mortgage program is uh, effectively the banking system's first real acknowledgement of that shift.
It's a bridge between the cold, hard reality of risk assessment and the messy, warm responsibility of taking care of your tribe.
Mm.
So if you're listening to this and you're in that squeeze looking at your parents' finances and getting worried, or looking at an adult child who needs support, this is your homework.
Don't just assume you can't afford it. Go look up Fannie Mae Guideline B2-1S01. But more importantly, talk to a lender who actually understands this.
But that's a key warning. Not every loan officer knows this exists.
Right. If you walk into a generic big box bank and say, I want to buy a house for my mom, 9 out of 10 tellers will just tick the investment property box.
Because it's easier.
It's easier. You need to advocate for yourself. Ask specifically about the family opportunity provision. If they give you a blank stare, find another lender.
Good advice. And as we wrap up, I want to leave you with a thought about where this is all going. We've been talking about how this rule bends the definition of primary residence.
Right. It decouples homeownership from occupancy.
Exactly. So as remote work keeps letting us live anywhere, and as housing costs force us to rethink how we live, do you think we'll see this definition expand even further?
That's a fascinating question.
Could we see a future where communal family ownership replaces the traditional mortgage, where the primary residence isn't about where you sleep, but where your family sleeps?
The definition of home is changing, and it looks like the mortgage industry is just starting to catch up.
Something to chew on. That is it for this deep dive into the family opportunity mortgage. Hopefully, we just saved you a tough conversation and maybe a lot of money. Thanks for listening.
Take care, everyone.